Turning 65 could now mean more than qualifying for Medicare and Social Security. A major federal tax change gives eligible seniors an extra deduction worth up to $6,000 per person, on top of the existing extra standard deduction for people 65 and older. For some couples, that could mean up to $12,000 more in deductions. But there are rules, income limits, and a few easy-to-miss details. The new $6,000 senior deduction. The biggest change is a new enhanced deduction for seniors. For tax years 2025 through 2028, taxpayers who are age 65 or older may qualify for an additional deduction of up to $6,000 per eligible person. This is important because it is not replacing the existing senior deduction, it is added on top of it. For example, a qualifying single senior could receive the normal standard deduction, the existing additional standard deduction for being 65 or older, and then potentially another $6,000 through the new senior deduction. For a married couple filing jointly, if both spouses qualify, the new deduction can reach $12,000 total. The IRS says the deduction is available whether a qualifying taxpayer takes the standard deduction or itemizes deductions. There are actually two senior tax breaks. This is where many people could get confused. The existing additional standard deduction has been around for years. In 2026, an unmarried taxpayer who is 65 or older generally receives an additional $2,050 on top of the regular standard deduction. For a married taxpayer who is 65 or older, the additional amount is generally $1,650. Then there is the new enhanced senior deduction, which can provide another $6,000 per qualifying person. So these are two separate benefits. That distinction matters because someone who is 65 or older should not assume the $6,000 replaces the normal age-based deduction. For 2026, the regular standard deduction is $16,100. For single filers, $32,200 for married couples filing jointly, and $24,150 for heads of household. The senior-related amounts can then increase the total deduction further, depending on the taxpayer's situation. Who can get the new deduction? The basic age requirement is straightforward. You must be 65 or older by the last day of the tax year. For the 2025 tax year, that generally means the taxpayer must have been born before January 2, 1961. For the 2026 tax year, the age requirement shifts forward 1 year. There is another important requirement. The taxpayer must have a valid Social Security number for purposes of claiming the enhanced senior deduction. If a married couple wants to claim the benefit, the couple generally must file a joint return. And remember, this is a federal tax deduction. It reduces the amount of income that is subject to federal income tax. It does not mean the government automatically sends a $6,000 check. That difference is extremely important. A deduction reduces taxable income. It is not the same thing as a $6,000 tax credit. The income limit many seniors need to know. The new deduction is not unlimited for higher income taxpayers. For a single filer, the enhanced senior deduction begins to phase out when modified adjusted gross income, or MAGI, goes above $75,000. For married couples filing jointly, the phase-out begins above $150,000. This does not necessarily mean someone above those numbers gets nothing immediately. Instead, the deduction is gradually reduced as income rises. That makes it important to look at the actual tax calculation instead of simply asking, did I make more than $75,000? Also remember that MAGI, for this particular deduction, is a tax calculation. So it may not be exactly the same number as the income shown on one particular form. The IRS specifically says the maximum deduction is reduced above the applicable income thresholds. Social Security doesn't automatically disqualify you. One common mistake is assuming that receiving Social Security means a senior cannot use the deduction. That is not how this benefit works. The new senior deduction is based primarily on age, filing status, Social Security number requirements, and the applicable income rules. A person receiving Social Security may still qualify. However, Social Security can be taxable depending on the taxpayer's overall income and circumstances. That means seniors should look at their complete tax picture rather than treating Social Security as automatically tax-free or automatically taxable. The key point is simple. Receiving Social Security by itself does not erase the new senior deduction. The same idea applies to other retirement income. A senior should consider wages, pensions, retirement account withdrawals, interest, dividends, and other income when determining the overall tax situation and whether the deduction is reduced by the income phase-out. What about married couples? Married couples have an especially important opportunity because the deduction is calculated per eligible person. If both spouses are at least 65 and meet the requirements, they can potentially receive $12,000 of enhanced senior deductions combined. But there is an important condition. Married taxpayers claiming the enhanced senior deduction generally need to file jointly. Consider a simple example. Imagine a married couple where both spouses are 68 years old and their income is within the applicable range. If both qualify, the new senior deduction could be worth up to $6,000 for one spouse, plus another $6,000 for the other spouse. That equals $12,000. And this is separate from the existing age-based additional standard deduction available under the tax rules. The exact tax savings will depend on the couple's taxable income and tax bracket. But the deduction can still be a meaningful benefit for households living on retirement income. You can claim it without itemizing. Another reason this deduction is easy to overlook is that some people think they need a huge list of expenses to qualify. They don't. The IRS says the enhanced senior deduction is available to eligible taxpayers who take the standard deduction or itemized deductions. That is important because many seniors use the standard deduction. For the 2026 tax year, the regular standard deduction is already $16,100 for a single taxpayer and $32,200 for a married couple filing jointly. The existing additional deduction for age can increase the amount further, and the new enhanced senior deduction can potentially add another $6,000 per eligible person. So a senior does not necessarily need to track a large pile of receipts simply to benefit from this particular deduction. Still, taxpayers should not assume they automatically qualify. The age, income, filing status, and Social Security number rules still apply. How seniors actually claim the new deduction. The IRS created Schedule 1A for the new deductions created under the law, including the enhanced deduction for seniors. For the 2025 tax year, taxpayers use Schedule 1A to calculate and claim the senior deduction. Tax software may ask questions about age, filing status, income, and other eligibility details. Paper filers need to follow the applicable Form 1040 and Schedule 1A instructions carefully. This is one reason seniors should not simply copy last year's tax return and assume everything is the same. The new deduction is a recent change. The IRS published the Schedule 1A instructions, specifically explaining how taxpayers can claim the enhanced senior deduction, including the $6,000 maximum per eligible person and the income phase-out. If someone uses a tax professional, it is also worth specifically asking whether the new enhanced senior deduction has been included. Don't confuse the deduction with $6,000 in cash. Finally, there is one point that deserves extra attention. A $6,000 deduction is not the same as a $6,000 tax refund. Suppose a qualifying senior receives a $6,000 deduction. That generally means up to $6,000 is removed from income that would otherwise be subject to federal income tax. The actual reduction in tax depends on the person's taxable income and applicable tax rate. For example, a $6,000 deduction could produce a much smaller tax reduction than $6,000. That is why headlines about the senior deduction can sometimes sound bigger than the actual cash benefit. Still, for someone living on a fixed retirement budget, reducing taxable income can matter. If you're 65 or older, don't stop at the regular standard deduction. The tax law now provides a new enhanced senior deduction of up to $6,000 per eligible person, while the existing age-based additional standard deduction remains in place. Income limits and other rules apply, so check the numbers carefully before filing. If this video helped you understand the change, like the video, subscribe to the channel, and share it with a senior or family member who could benefit from knowing about this tax break. See you in the next one.